This video is looking for accounting for assets, including property, plant and equipment and impairment losses. What we'll be doing is discussing the nature of property, plant and equipment, outlining the recognition criteria for the initial recognition of property, plant and equipment, explaining how to measure property, plant and equipment on initial recognition, and explain the alternative ways in which property, plant and equipment can be measured subsequent to initial recognition. We're going to then look at the cost model of measurement, understand the nature and calculation of depreciation. We'll then look at the revaluation model of measurement, account for derecognition, and outline the disclosure requirements of AASB 116. AASB 116 defines property, plant and equipment as equipment that is held for use in the production or supply of goods or services, for rental to others, or for administrative purposes. They are expected to be used more than one period, which means that they will always be classified as a non-current asset. These particular assets have a specific use within the entity. So therefore you can see that they would be a tangible asset. The standard does not apply to other particular types of property, plant and equipment which are held for sale and investment, biological assets and mining assets. Property, plant and equipment are normally divided into classes. Some common examples of classes would be land, a separate class for your buildings, reasons being that they would be land is not depreciated and buildings can be, machinery, motor vehicles. Other groupings might be office equipment, ships, furniture and fixtures, and bearer plants when we discuss biological assets. This grouping is particularly relevant when we look at the revaluation model. Property, plant and equipment is considered as recognition of the asset, initial measurement of the asset, measurement subsequent to initial recognition, derecognition of the asset, and disclosure requirements. The standard also records how or when you should recognise an asset, and it states that the cost of an asset is recognised if it is probable that economic benefits will flow to the entity, so that means more likely than less likely, and the cost can be measured reliably. So these recognition criteria align with what's in the conceptual framework. The outlay must give rise to the expectation of future economic benefits, once again relating back to our definition of an asset. The term measured reliably refers to the recognition of property, plant and equipment only where the measurement purports to faithfully represent the economic substance of the item and is free from. The standard also states that the cost of an item is to be recognised as an asset if it is probable that economic benefits will flow to the entity. So that means that there's more likely than less likely, and the cost can be measured reliably. So these two recognition criteria align with our definition of assets in the conceptual framework. The standard also says that the outlay must give rise to the expectation of future economic benefits. And if you think about it, when you have an expenditure, one of the choices that you have to make is whether you expense it straight away or you capitalise it and record it as an asset. And to record it as an asset, it has to have this expectation of future economic benefits. Sometimes that can be quite easy to obtain because if it has a market value, then at least you would know that it has economic benefits through the sale of the asset. But often the asset's value is perhaps not even on its own, but in combination with other assets where its use or consumption will then result in future economic benefits. The term measured reliably refers to the recognition of property, plant and equipment only where the measurement purports to faithfully represent the economic substance of the item and is free from material error or basis bias. As a result, what that means is that users can rely on that information, and it's reliable in the fact that it should actually give you a good estimate of what those future economic benefits will be. The standard also refers to the significance parts approach. So if you think about property, plant and equipment, you could understand that often some of these assets are broken down into separate assets as such. What you need to do is recognise both the value of the asset and the expected benefits consumed by the entity during the period in which the benefits are received. Thinking about an aircraft is a good example of a piece of equipment that has significant parts. So of course in the aircraft there would be the engine, and of course the usage or consumption associated with that engine would be different to other parts of the aircraft. For instance, the cockpit equipment would include computers and navigation equipment. Also, if you think about the aircraft, that also would have seating arrangements, and again that would be a significant part of that asset aircraft, and so therefore it could also be consumed or used up at a different rate than other parts of the aircraft. The standard itself does not actually prescribe the unit of measurement for recognition or what constitutes an item, so in this case you do have to use your own professional judgment. Having established that an asset can be recognised, the entity must then assign a monetary amount to it. So the standard in paragraph 15 says that the initial measurement is the cost of the asset. An item of property, plant and equipment that qualifies for recognition as an asset shall be measured at its cost. What we then have to determine is, well, what does this cost consist of? So the standard itself actually identifies three components of cost: purchase price, directly attributable costs, the initial estimate of the cost of dismantling and removing the item or restoring the site on which it is located. Purchase price is the basic cost of the asset. That essentially is the amount given up by the acquirer to acquire the asset at the acquisition date. And so that would normally involve some sort of outflow of cash or equivalent or other consideration. In times there can be perhaps traded assets, and so in that situation, or a swap of assets, then what you need to do is apply the fair value of those transferred assets. What that then means is that the purchase price of that asset is at its fair value. If on transferring an asset as part of the transaction, at times there may be a profit or loss on the transfer of that asset, and that should then also be recognised. If you look at the definition there, it says that the asset is measured at the cost at the acquisition date. So you have to determine when that acquisition date may be. And sometimes that can be problematic, but it could be the date of the contract to exchange the assets, the date the consideration is paid, or the date in which the assets are acquired or received by the acquirer, or the date on which an offer becomes unconditional. So these all relate to a specific point of time and can be determined objectively. However, there can be a problem where there are a number of dates involved. If, for an example, an item of equipment arrives in stages, or the payment for the equipment is to be made in instalments over time. So going back to our definition of an asset, then the date of acquisition would be the date that the business or the company acquires control of the asset. Another issue that can arise is where perhaps you are acquiring a bundle of assets which do not represent a business combination as such, and so you have to allocate, you pay one amount for that bundle or multiple assets, and you have to allocate a cost to each of those assets within that bundle, and you do that according to their fair values. There is an example in your textbook of how this is applied. Any directly attributable costs are also capitalised into the cost of assets, and so therefore that could include things such as employee benefits arising directly from the construction or acquisition of the property, plant and equipment. So whereas normally if you were constructing an asset, those wages expense you might consider expensing. However, when you are constructing an asset, then they can be included as part of the cost of that asset rather than being expensed straight away. Any costs of site preparation would be included. Initial delivery and handling costs, installation and assembly costs. This also could include the cost of renovation, any costs of testing to check that the asset is functioning properly, and any professional fees. But they do have to be necessary costs. There are some exclusions from these directly attributable costs. So for instance, the costs of opening a new facilities, these are costs incurred after the property, plant and equipment is capable of being used. So for instance, the opening ceremony, this is not an allowable cost. It has to be expense. It doesn't really have any impact on the operating ability of the asset. Once again, the cost of introducing a new product or service, so that includes things such as advertising and promotional costs, and so they are not to be included, they are to be expensed. Costs of conducting a business in a new location with a new class of customer, costs of staff training associated with this. And so therefore, there is no change in the asset's ability to operate, so therefore they're not allowable either. Just the general admin and overhead costs, costs incurred while an item capable of operating in the manner intended by management has yet to be brought into use or is operated at less than full capacity. Okay, so that's more of a timing issue, and so therefore those costs are not included either. Initial operating losses, once again, if when you first start to use the asset, the demand might not be there, and so therefore you're making losses on those asset, and you're not allowed to take them up. They have to be expensed in the period. Costs of relocating or organising all part of the entity's operations, they also have to be expensed. And it is important for the standard to establish what can and cannot be capitalised within the cost of this asset, because if you think about it, it's going to have a direct impact on the profit. If you expense something, obviously that will reduce your profit, whereas if you have the ability to capitalise it, well, that will result in an increase in the current year profit in particular, and then you would have an asset on your financial position. And so therefore, although you will depreciate that asset in the future, it can have an effect on your profit measurement. Another aspect to be considered is, well, sometimes when you are getting an asset ready for use, then you could actually earn some income in relation to it. So any proceeds from selling an item produced when bringing the asset to the location or condition ready for operation. So for instance, you might be in the process of producing some samples, and then they can then subsequently be sold. So any of those revenue flows from those activities need to be treated as a reduction in the cost of the asset. The reason being is that the testing process is part of readying the asset for its ultimate use. And so all those costs, and in this case revenues, are treated as part of the calculation of the cost of the asset, in this case as a reduction of the cost rather than revenue, because you're getting that asset ready for use. Another situation that can arise is, well, okay, an entity may acquire an asset for a zero cost or be required to pay an amount which is substantially different from the fair value of the asset. And as we said, the cost is deemed to be the fair value at acquisition date. The situation for profit organisations is that if they do receive an asset at zero cost, then they would not record the asset. If it's a heavily discounted asset, then, and they're only required to pay a nominal amount, and then that would be the amount plus any directly attributable costs that they would record. So it's the purchase price, essentially what the entity is giving up to acquire that asset. However, it is different for not-for-profit entities, and the not-for-profit sector is certainly expanding in Australia. And in that situation, and as you could imagine, often not-for-profits are given items or donated items. I'm aware of a situation where a company or a not-for-profit received a building from a particular organisation. So they have to make a decision as to, first of all, do they have control of that asset? And if they have control of that asset, then they have to record that at the fair value of the asset. So that would require them to record a journal entry where they would debit the asset, for instance building, and credit gain, which would be recorded in their profit and loss. So as I said, this is a situation which is particular to Australian entities where, as I said, for-profit organisations only record at the cost of the fair value of what they're giving up, which if the case is at zero, then that's not recorded, or the minimal amount, whereas we have a different situation for for-profit entities. And if they receive an asset at zero cost, then if they control that asset, then they would record it at its fair value. Another area that the standard also looks at is the cost of dismantling, removal or restoration. At the date the asset is initially recognised, an entity is required to estimate any costs necessary to eventually dismantle and remove the asset and restore the site. And probably an oil platform is a good example of this, where once that oil platform is no longer required, by law they are to dismantle and remove the platform in such a manner that it takes or doesn't destruct the environment. We looked at liabilities in a previous week, where we looked at the standard AASB 137, provisions, contingent liabilities and contingent assets. And we looked there that we would have to set up a provision, which is actually measured at present value basis and of the cost of perhaps dismantling, in this instance, the platform. Rather than debiting an expense and crediting a provision, what we would do in this case is the debit would then be added to the cost of the asset. And then subsequently, that would then be included as part of the depreciation of the asset over its useful life.